Hi, I'm Daniel Schwartzman, Director of the Seeking Alpha Marketplace. Today I'm joined by Lawrence Fuller, author of The Portfolio Architect, a marketplace service that offers a foundation, framework, and discipline for optimizing portfolio performance. Lawrence, good morning.
Good morning. How are you?
I'm doing well. How are you?
Good, good.
So, we recently did a roundtable discussion on the macro environment, and obviously you're writing about it, and as you were just saying, you're thinking about it a lot.
Right,
One of the points you made was we don't really know earnings, right? We don't really
right.
know, and that's what valuations are based on. And there are so many unknowns right now in general. So, how are you thinking about that? How are you dealing with all these? What are you putting emphasis on, or how are you trying to navigate right now?
Well, I'm not looking at market upside, obviously. Everyone's looking at downside, right? So I think one of the ways you explain where the market is today, the S&P around 2,800, is, which doesn't make a whole lot of sense, is that the consensus estimates out there for earnings right now are that we're only going to see something in the neighborhood of a 6 to 8% drop in S&P earnings for 2020.
Mhm.
Revenues are expected to be flat, which makes no sense whatsoever. But that's sort of consistent with where the market is right now, with the S&P down about 13% year to date. That's not too far off. So more realistic would be, given what we're seeing in GDP projections, is that we're going to see this huge decline in the second quarter, maybe a little bit of a less decline in the third, and then a rebound in the fourth. So I think a reasonable expectation is to see GDP contract somewhere around 7 to 8% for the year. And if I run off that number, which is a pretty ugly number,
Mhm.
I think you're going to see S&P earnings decline somewhere anywhere between 30 to 40% for the year. So, I'm looking at the way I'm looking at it is I'm saying, okay, well, S&P earned 162 last year. If I take 30 to 40% off that number, I come up with something in the neighborhood of, and I wrote it down, I can't remember, 113 to 97.
Okay.
So, in the last two bear markets, the market bottomed at about 20 times trough earnings. So if I put a 20 multiple, and these are just hypotheticals, but if I put a 20 multiple on those earnings estimates for the S&P, I come up with something around 2,200 to 1,900 in that range.
Okay.
So that's my downside target for the S&P is 2,000, and someone might say, well, why? That's what a convenient number, but that it's not really convenient. It's sort of it's a psychological line, because I think if you saw the S&P get down towards 2,000, that would be a psychological support level. If we were to dip below it, which you might, I think you'd see some support in there, and the market would bounce at that level. So that right now is my downside, a worst case. The the other part of it that I don't know is how are we going to come out of this, and how are things going to change in terms of social distancing. I know you're already hearing, because I'm those forecasts are sort of based on, we reopen the economy in the second half of the year and things get back to normal. We come up with a treatment, we eventually have a vaccine, and life goes back to normal. But the the aspect of social distancing, where you're already starting to hear airlines are going to not have anybody sit in the middle seat,
Mhm.
which I'm all for, virus or not, but because I always end up in the middle seat. But nobody in the middle seat on an airline, or you walk into a restaurant. Some of my favorite restaurants, there's 100 people in the restaurant, and you're a foot away from the person on either side of you. Well, they may have to take out a third of the tables in the restaurant, so you're going to have a bit of a capacity shock, and then you're also going to have, I'm sorry, a supply shock, which would be capacity. You're also going to have a demand shock, because people are going to want to get out and start doing things again.
Mhm.
So those two combinations right there, I think, are going to lead to at least, if it's temporary or immediate, a spike in inflation, or a rise in prices. Okay, and those are things that you've got to kind of factor in. I think the economy comes back very quickly when we do reopen, but then there's a lull when we come back down. We sort of have to factor in this new way of life, which could last as long as months, to the point where we actually have a vaccine. So
Right. So
that's
one
that's
other
sort of a yeah.
well, so within that also is sort of the stimulus too, right? Because there's
Well,
unprecedented
that's
amount of fiscal monetary stimulus. There's probably
right.
more coming. How does that and that's most people are just throwing, not most people I see are throwing their hands up, value investor types or more
Yeah.
traditional types, saying it's all the Fed. But like, how are you thinking about that? What's going on
Well,
there?
yeah, it's and that's the, I think of the I think of the physical and the monetary stimulus as sort of like floaties on a baby in each arm of the pool, kind of just holding valuations up, which is the whole idea behind the monetary stimulus. But the stimulus is huge, and it's to put it, I think it's being discounted. I don't think it's being fully discounted in some of the worst case outlooks or scenarios for the market. Okay. But in '08, we had stimulus is about 3% of GDP. This is 3 times that. The fiscal side of the stimulus is 9 to 10% of GDP. So if you assume, in my case, I'm saying, hey, we could have the economy contract, let's say up to 9 or 10%, GDP declines. That well, that's how much stimulus there is out there right now. So it's sort of trying to offset the contraction in economic activity, and it's on par with where we are right now. So I think the stimulus we've got, you know, both Congress as well as the Fed have said we're just going to give you as much as you want. I mean, it's unlimited, so certainly on the Fed side. But what's different about '08 is that the reason we had no inflation is that the primary stimulus was monetary. So all that inflated were asset prices, financial asset prices. There wasn't a whole lot of stimulus for mom and pop. This time around, you're getting much more of a balance between the two. Right now the monetary stimulus is around 4 trillion. The fiscal stimulus is around 2.3. So, and I know that the focus right now is on how poor it's been organized, administrated, dispersed, who doesn't have it, who's not getting it, which today it's about the checks are going into people's accounts that are not they passed away, or it's the wrong account, or and I can appreciate all that. So there's a lot of negativity about the fiscal stimulus as it stands right now. But the bottom line is that people are going to get it eventually, and some aren't going to get it in time, and there'll be businesses that fail, and there'll be people that can't make their payments. But in aggregate, it's going to have a big effect in a month or two when, for example, you have 20 million people that are unemployed and are receiving payments that are 3 times what they normally would. A lot of those people are going to be making more money not working than they were when they were working. So since the vast majority of these jobs are service-oriented jobs, the people in, well, the service industries, my guess is that most of them aren't making $50,000 a year, which is what many of them will be making when they receive the average check. The average unemployment check is, I think, $360, $370. So that's going to be increased by $600. So that's $1,000 a week on top of the stimulus checks you're going to get, which are $1,200 per adult, $500 per child. So again, we're going to see this huge contraction. But I think when you start reopening the economy and people can go out and start spending money again, there's going to be a little bit of discretionary income that's not being accounted for. So, I think the focus right now is on all the negatives, but there will be some positives when we come out of this.
So that actually sets up sort of between the two questions then, or the two things we talked about, is I think everybody's eager to just look through 2020 and write it off, and
Oh yeah,
however they put it, it's essentially everybody's just baking in what you said. It's whether it's V-shaped, W-shaped, whatever. But the idea is that we'll get on the other side of this. The government understands that this is not a traditional. It's not the 2008 bank failure. There's less moral.
right.
I know people disagree, but there's less moral hazard or whatever else, and so we really just need to freeze the economy and then reheat it right again. And so, does that affect how you're positioning in terms of you talk about this 20 times trough earnings as a bottom, but does the fact that we can see the other side of this, obviously still a lot of unknowns when the other side happens, et cetera, but like, does that affect how you're positioning or how you're thinking about things?
Well, I mean, yeah, I think the it's very hard to make a one-dimensional call right now. So the way my investment strategy is structured, and it's an adaptation off Ray Dalio's all-weather strategy. which is that I've always got a core exposure to each asset class. So my strategy is a function of having, X percentage in equities, fixed income, commodities, and a fair amount of liquidity, so that when I make directional bets, either bullish or bearish, if I'm wrong, I'm not out of the market. Okay. So with the surge that we've had in gold prices, which is a core holding for me all times, I'm not asking myself the question, should I be in gold or should I? Has it run up too much? Is it going to pull back? I'm always there. And when I feel like, there's good reason to see gold outperform or commodities outperform in general, I can increase my exposure on top of my core tactically and beef that up. And so I've done the same thing with equities is defensively positioned at the beginning of the year, not because of the virus, but because I saw a lot of weakness in the economy, saw a big divergence between what looked like kind of a blow off top in the stock market as the rest of the economy was continuing to slow. Then the virus hit. Then we had this plunge. And so when we got really oversold readings in the market, I shifted some of my liquidity into the stock market. And as we've come back up to now what's about the 50-day moving average on the S&P, I've been paring that back. So I'm looking to do that again in the future months as the market gyrates. I think yesterday was a day where we had a big down day because we got some real, a dose of reality in terms of the economic statistics, from retail sales to industrial production to housing. So it's like, it's kind of like being drunk on Fed liquidity, and then all of a sudden you get punched in the face by the real economy. And then you have so that's going to be a battle back and forth. It's going to be the Fed against the virus, so to speak, But I think that there's going to be more negative news, obviously a lot more negative news than positive news over the next couple of months. So my inclination is to believe that we're going to keep sort of staircasing down till we find that trough valuation. And as we get there, I'm going to shift my allocation to a much more aggressive posture. I'll be more targeted weighted to possibly slightly overweighted in equities, definitely so in commodities. And and that's the way I'm playing it. So at that 2,000 level that I'm targeting, one of the reasons I think you got to have a level like that is that if you're gonna invest money tactically, you kind of have to sort of grade in. You can't pick a bottom and say, here's where I'm going to step in and load the boat. I mean, you kind of have to. So when the market was dropping in March, it was gradually putting money in over about a 6-day period as we sort of troughed and then stopped. And I'm doing the same thing as we're approaching the 50 days. I'm just trying to gradually reduce risk, add some hedges. And, I think you repeat that process until we find a bottom.
So when you're the way you're describing it, the core portfolio is more or less based on your longer term portfolio. Yeah. And then,
it's like if I have a target, if I was just to have a strategic allocation, which means I just rebalance it once a year, and based on my age, my tolerance for risk, my objectives, I was going to try to maintain 60% in the stock market, 30% in the bond market, the remainder in cash, and maybe a commodity weighting. That might be my targeted weighting for equities. If I became real cautious or defensive about the market, I could reduce that from 60 to what would be a core weighting, let's say would be 30. So I move that difference into cash. Okay. And I'm going to sit tight and wait for it till I have a better feel for what the fundamentals are. And I like if I start thinking the outlook looks more positive, then I'll bring my core back up to my target over time. So that's the way I look at it. Okay. Yeah.
So a last question for you. You mentioned commodities as something that you're especially interested in. To a lot of us, we hear commodities, we think of gold, which you've already kind of talked, and obviously inflation, but also oil, which has not had the best time of it. So could you just talk a little bit more about why commodities, why did you mention that as a specific area to overweight?
I think for me, they're a little more predictable than the stock market is right now. So, I made some tactical trades in different commodities. Coffee, for example, which I'm long right now. Oil prices off the $20 level. I've traded once fortunately had a good trade there thanks to one of Trump's tweets, which I took the money off the table quickly, and now I'm back in oil again at 20, hoping that we get a bounce here technically from the $20 level. Sugar is another commodity that's at a decade low, and when I'm talking about prices, I'm talking about futures prices, obviously, not talking about the ETNs or ETFs that reflect them, but sugar at $10 is a multi-year low. So some of these individual ones have good supply-demand dynamics where it makes a lot of sense to own them long term. But then gold obviously has had an explosive move recently, and I actually pared that back, the money I had in the gold mining ETFs. Okay. I think gold just got a little bit ahead of itself. So, but the commodities trade, especially oil, more like stocks than they do commodities, because what drives the price up and down in the short to intermediate term is not real world supply demand, but speculative money that's moving in and out of the commodity. Right. So you can, if you know the underlying supply demand issue is a bullish one for the commodity, and you can find some technical areas of support where the speculators are trading it, that puts a little bit of wind in your sails. So
okay, all right, very good. Yeah, it's the commodity sector is interesting because people are looking at it as potentially an inflation hedge as well. If with all
totally, with respect to gold, I think for sure it's I mean gold goes up and down. You'll hear different reasons for why it's going. I mean, it could be inflation, it could be fear. It could be all the money printing that's going on, negative real rates. There's lots of reasons for it. It's just a store of value. I think one of the reasons gold didn't perform as well as I thought it would have was in part because of all the cryptocurrency popularity. But for some reason, right now.
That took away investors' attention.
Yeah, money that would normally have gone into gold went into Bitcoin. Okay. Or any number of other cryptocurrencies, and because that was sort of the faddish thing to do at that time.
Right.
And that's as that's faded, gold all of a sudden it's gotten to be a lot more popular. So.
Okay, great. Any disclosures? So you mentioned coffee, gold, and oil.
Yeah, right now in my commodity portfolio, I'm long gold, silver, coffee, sugar, and oil. So. In that basket, yeah.
Okay, great. Good stuff.
Yep.
Oh, okay, thank you. So again, speaking with Lawrence Fuller of the Portfolio Architect, you can check out his work on Seeking Alpha at the Seeking Alpha Marketplace. Just type in Lawrence or Fuller or the Portfolio Architect in any of our search bars and you'll find it. Lawrence, thank you so much for your time this morning. Really
enjoyed
the conversation. Thank you. Best of luck out there.
Appreciate it.